Let me introduce Greg to you. I've been working with Greg for about 4 years, might even be a little bit longer than that now. Yeah. We pulled together various pension pots that we had, and we created a family Ssas. So it's myself, my husband, and my daughter. We'll talk about this later, but our intention is to use this facility to pass property down to our daughter without capital gains tax, whilst providing a facility to do lots of things. So within my Ssas, which I know we're property focused here, we have borrowed money from the Ssas to use for residential development. We've bought and sold commercial property through the Ssas, and we've bought and developed commercial property. So our latest project is the one I've just been talking about, which is Work Hub, which I know if you've seen my Insta, you'll have seen the photos. And we now have an office block, which is all taken care of through the Ssas. So Greg's helped me every step of the way here. He's a great contact. And Greg is going to explain what his company can do, and also explain what you can do with the Ssas, because there are so many options.
But thank you so much for having me on, and what I love the group to present to. So I'll start off just briefly explaining a little bit about myself and also the business, and then I'll sort of go through some of the agenda items that Suzanne kindly put forward that hopefully is going to be useful for you all. So I suppose to go back in time, our business was originally founded in 1991, and it was Ian Mattioli and Bob Woods that established the business, and they had both had very successful careers in the financial service industry, and they wanted to do things a slightly different way, because at that point in time it was very much focused on product and not sort of creating long-term structures and a service. And most pensions back then in the 90s, you used to save, and then you'd have to buy an annuity. And the problem with that is you'd lose all your control, and although it'd be great and it's still appropriate for some people, you'd turn that big lump of capital into something that you no longer have access to on a very flexible basis, or to pass down the family line. So they sort of wanted to do things a different way, and also wanted to charge people instead of a percentage that got paid whether you did work or not under the old commission model, on a fee basis. So clients paid for a genuine service and a very trusted long-term service. So the business started in 91. It was in Ian's tastefully converted garage in his home in Leicester, and the business very quickly grew organically and then later through acquisition. The group now has around 600 people. We've got around 9.4 billion of client assets that we are entrusted with and manage, and that spans across 11 offices at the moment. So that's just a very brief synopsis, and more details are on our website. In terms of what we strive to do for our clients, our sort of focus and USP is to really have an integrated model. So when you're delivering somebody full holistic wealth management services, there are a number of different services. So financial planning is one, and that's really important. And I'll come on to that. That's looking at your structure, your tax, and other sort of long-term objectives. It's then having appropriate products. And products are things like we'll talk about today, like a Ssas or a SIPP pension scheme. It could be other things like ISAs and so on. So you've got to find sometimes products to meet a need. And then at times also you might need investment management. And that's where, if you're not making the day-to-day decisions, you might entrust somebody else to do that for you. And we've strived very hard as a business to make sure that we can offer all those core services in-house, so we can deliver a fully integrated proposition. And we find that creates not only more consistency, but much more efficiencies from ideally a cost and also an administrative and a people perspective, because you only have to deal with the one organisation that knows you intimately. So that's just, again, a background on us, but please do visit the website for more information. In fact, one last thing, actually, I really like this slide. That it's some words from our founder and CEO, Ian. And I think that the key there is some of those core words of soul, culture, and values. And that's hugely, hugely important when you're building a business. And I'm sure many people on this call have, who have successful businesses, and just looking at the success of this group, it needs a soul, it needs a culture, and it needs to have values. And they're three really, really important things that makes our business so strong. And I think I'll mention this now because it will become integral when we talk about things like structure and costs and other sort of, can you do it yourself or use somebody? Again, all the options are there, but what we're trying to do with our business and what we'll continue to strive to do is create something that can be cascaded. So Ian and Bob, when they floated the business in 2005, they could have just sold it. It would have been an easier option. Bag of cash, walk away, retire early, fantastic. But actually the harder route was to think about how we transition our clients from generation to generation. And we found that doing what we've done has enabled us to build a structure that allows for sensible growth and aspiration in-house and people that work with us. So, take myself, for example. I've been with the business since I graduated at university for 14 years. My colleague James has been here for, I think, nearly 10 years as well. And a lot of our staff are very long term, and that's because we want them to grow and we want them to get ownership in the business that they're part of at all levels, so that we have a business that can cascade things down. And that's, again, comes down to our culture, our values, and that's just because we want to put our clients first at all times and the service we deliver. So in terms of what we want to try and answer today or get across, Suzanne kindly put a few questions ahead. So we're going to try and cover sort of retirement investment assets. So obviously property is a big one given the group that we're in, but there are some non-property options I'll touch on. Why pensions and what are the tax benefits? And what's the difference between the different structures, SIPP, Ssas and off-the-shelf pensions? I'll go through some self-investment options, so how we might be able to use pensions to restructure assets, talk about how you might be able to loan monies back, answer an age-old question: can you invest your monies in residential property? And we'll talk about also some wider structures and other areas like inheritance tax that might be also pertinent. If anyone's got any questions, obviously fire them through to the group, and we'll endeavour to answer them. And equally, if someone feels something's not answered, we're more than happy to speak to you on a one-to-one basis afterwards. It's not a problem. So the first question I'll try and answer is property and non-property. What are the options? So before I do that, I'm going to ask set out another scene, which is the way I try and approach things with clients is to look from the other end of the telescope. And what I mean by that is try and find out what journey we're trying to walk towards, i.e. where we might want to end up in so many years' time, and then we can sort of set the scene and set our foundation correct. So the first thing I'll say is it's not about choosing the asset first. For me, it's about getting your structure right. So, and there's lots of different structures out there. There's pensions, as we'll go on today, is one. You'll have a limited company. You'll have ISAs. There's other structures I'll come on to later: VCTs, EIS, investment bonds, trusts, just investing directly. So that's looking at your structure, and that will look at things like tax. It will look at things like inheritance. It might look at things about how your income can be cascaded down to you and others in the future. So I think for me, when we look at what's right, property and non-property, pension or non-pension, it's such an open question. There isn't a right or a wrong, but it's about looking at the structure first and then ultimately finding the right assets to fit in that structure. So again, in terms of assets, there are lots of different things that can be considered. The main four asset classes that we normally talk through are sort of cash, bonds, property and equities. Cash being money in the bank, bonds being effectively loans to sort of big institutions like governments and even corporates, where we've just got either a short or medium or long-term loan with a fixed rate of interest. Property, I won't say much more on that given the experience in this group, but you can have residential and commercial, and sometimes a combination of the two through mixed use. And equities, which is investing in companies. Then you can invest in very small companies which are unquoted, not on a stock market, all the way to quoted equities, and there's a big scale there from very small caps to very large cap, like your Amazons of this world. So they're all different options that can be considered, and there isn't a right or wrong. It's always circumstantial. It's down to the individual, what we're trying to achieve, what risk we might need and is appropriate, what sort of return profile we're looking for, liquidity, do we need access? Property is fantastic, you can gear it up, as you'll all know, hopefully generate a long-term income, but it's not easy to get cash out. You've either got to try and restructure debt or sell it, and that takes time. So, having a blend of different assets is important. Commodities alternatives are again other areas that we do deal in. I can come back onto that another point if people have specific questions, but the answer is there's lots of options out there, so keep an open mind. So I'm going to touch on why pension schemes are important, and going back to that structural piece. For me, it's not about pensions is the only tool. As I said, it depends on what's important, but I generally find that for a lot of clients that I have, pensions do form a key part of their long-term plans. And why is that? So firstly, we all have to have something in the future to live on. The state pension at the present time is around about, give or take, £8,000 a year if you've got a full record. It might be a bit more, it might be a bit lower, it depends on different factors, but that's not going to give you probably the lifestyle that you would like to have in retirement, and nor should the state be paying for us all to have fabulous retirement. It is down to your own self-work and commitment. So what they do is they incentivize us to save, and they do that quite heavily through pensions. So every time you put money into a pension scheme, you get to save tax. So for an individual, that is tax relief against your earned income. And if you're a business, that's corporation tax relief. So I'll come on to some examples later, but for example, if you have a profit in your limited company of, say, £100,000, ordinarily you would pay a 19% corporation tax, £19,000. Hypothetically, if you were to put all of that £100,000, if you had it in cash as well, into a pension scheme and it was allowable in terms of limits, there'd be no corporation tax because it's treated as a cost to the business and tax deductible. For individuals, if you are either a basic rate or a high rate or an additional rate taxpayer, you can get tax relief against that income. For example, somebody with a salary of £100,000, for the £50,000 they earn, between 0 and 50, they're paying broadly basic rate tax, minus a personal allowance. For the other 50,000, they're paying 40% tax. And for those that earn more than that, the tax rates can be much higher. If you were to put some of that money into a pension, you save that tax. And the way I look at it is, if you're trying to get, again, looking from the other end of the telescope, if you're trying to get somewhere, if you can get there and save some of that tax early, it's going to have a massive compound effect for the next 10, 5, 10, 15, 20, 30 years, compared to paying the tax and then having to invest it. So for me, tax relief plays a really, really key part as part of building long-term wealth. It's often by far the most substantial upfront return you'll ever get. I'll come back onto some of the sort of contributions options in a minute around pensions. Also, you get tax-free growth with pension schemes. So investments in a pension grow free of income tax and capital gains tax. That's obviously providing they're the allowable investments. So sadly, at the moment, you can't invest in residential property directly. So if you did, you won't benefit from that tax-free growth. In fact, there's tax charges. But as long as you've got investments that are allowable, and most things are, then they will benefit from tax-free growth. So again, the fact you've had tax relief up front and then you paid no tax on your investment returns for a long period of time really exacerbates that compound effect compared to investing in a post-tax environment. So again, it helps you on that journey. When you hit retirement age, which is currently 55, but it is likely to increase to 57, possibly 58 in around 7-8 years' time, you can take up to 25% of your pot tax-free, and that can be either taken in one go or in stages. So if you had a pot of £1 million, to use simple numbers, you could take up to £250,000 tax-free, either in a chunk. There you go and buy a nice car, do whatever, enjoy it, or draw it down over a period of years, what's called phased drawdown. Equally, the other 75% of the pot can be used to support a taxable income. Now, you can either go back to buying an annuity, which was sort of the default option many years ago, and again, for some people that is important and sensible, and that's where you use that capital to buy secure long-term income. Alternatively, you can physically draw money down from your pension pot and just pay income tax on it. So again, just using that example, if you had £1 million, you could have up to 25% tax-free cash, circa £750,000. You could then either use to buy an annuity or use part of it to buy an annuity, or keep the whole lot invested and just draw a physical income from that money. So it's a bit like a magic pot you can just draw down from, but as I'll come on to, that comes down with responsibility. If you're managing that drawdown decision, it's got to be sustainable. If you spend it all, there's none left, and you can't. There's nothing there to sort of feed your income. So advice sustainability is key. And another sort of advantage is that pension schemes are not part of your personal estate, so they don't form part of the inheritance tax rules. Pensions themselves have their own special tax rules, and if you're unfortunate to die before the age of 75, your entire pension pot value can be cascaded to your beneficiaries free of tax. If death occurred after age 75, the value of your pension pot is not taxed. It's not part of inheritance tax. Your beneficiaries can inherit it, and they can draw down an income when they choose to, and just pay income tax at their rates. So in some ways, many of my clients sort of use this as not only a vehicle to provide their income if and when needed, but also as a useful sort of trust that can be used to cascade down to the future beneficiaries, bearing in mind that it's growing free of tax as well, which is very, very pertinent point. So that's often why pensions are a useful part of the toolkit in terms of building wealth for the future. In terms of how much we can put in a year, there's something called the annual allowance. It's ordinarily £40,000 per individual per tax year. There are some rules and regulations, so it is a little bit complex. I'll try and sort of not overcomplicate ourselves here for the purpose of today. But in short, if you're making a personal contribution from your own personal bank account or directly from your earnings, if you're employed, it needs to be, you can only get tax relief on your employment earnings. So it's not investment income. So that means dividend income, interest, rental income is not allowable it cannot be used you can't get tax relief on those earnings. It's only on employment income, so that's genuine employment, self-employment, could be bonuses, things like that. Anything on a P60, basically. If it's coming from the company, obviously it's treated as a corporation tax expense, but there is a sort of a wording where it has to be wholly and exclusively. And that means it just needs to be sensible in context of the business. And your accountant would usually assist to make sure that's the case. Now, there are some quirks around that £40,000 limit, and sometimes people might have less than that. They get tapered, and that's been brought in if you have a certain level of earnings. In short, and I won't go through the complexities, but if your adjusted earnings, which is everything that you have that comes in on a tax return, so that will be salary, bonus, dividend, investment income, bank interest, all of that sort of stuff, if that exceeds £250,000, and that also includes employer pension contributions, for every £2 over that mark, you lose £1 of that £40,000 limit. So, for example, if somebody had adjusted earnings of 300,000 for a tax year, they are, sorry, it was over £240,000, not 250. They are £60,000 above the £240,000 threshold. If you divide that by 2, that's 30,000. So the normal £40,000 allowance has now been cut by 30,000, so you'd only have £10,000 in that tax year. It's quite a complex calculation, but all I'd say is if your earnings are above 200,000, you need to sort of get advice to make sure you're check if you're tapered or not. Now there is a de minimis, so even if you are tapered, you're allowed a massive amount of £4,000 a year to still get full tax relief, and that really only applies to somebody who's got earnings, adjusted earnings in excess of 312,000. Now you can use, fortunately, you can go back over prior tax years. So the 40,000 is per tax year, and the government allows us to look back over the last 3 tax years. So let's just say ordinarily you've got a £40,000 allowance now for 2021. You've also potentially got up to £40,000 for the last 3 tax years. So if you take away anything that you might have put into pensions, the balance of those 40s from the previous 3 tax years can also be brought forward to the current tax year. You use the current year first, so we always feel, so the way I look at it is if you get, 2021 is our current pint pot, we have to drink that first, and then we go back to the oldest pint pot, which will be, I think, 2017-18 tax year, and move forward. So you can carry forward unused allowances. In order to do that, you must have just been a member of a pension scheme somewhere in those prior tax years. There's another limit as well called lifetime limit, and this is the overall maximum that you can save in pensions tax efficiently without incurring an excess charge. Doesn't matter if you go above it, you can go above it. There's not an immediate penalty, but it's just there are things to bear in mind, which I'll come on to. So the current lifetime allowance is a little over 1.07 million, and that's due to increase with CPI. You can still apply for some types of protection, so you can potentially have a limit of 1.25 million, or protect up to 1.25 million today, providing that you've not made pension contributions since after 6th of April 2016. If that's the case, get in touch if you feel you're near the limit, because it might be worth just checking if you should apply for this protection. If you do apply for that protection, you can't make any pension contributions, otherwise you'll lose it. But in short, the lifetime allowance is the maximum saving limit that you can crystallise and draw pension benefits from. Now, if you go over it, what's the implications? Well, one, it means you've done a very good job at saving pension wealth. So it's like anything, it's a good problem to have. All it means is that if you wanted to draw anything above that, so i.e. 25% lump sum or income under the normal provisions we went through before, you just have to pay an excess charge. So again, it's not the end of the world. I'd say I'd rather have the money and pay a bit of tax on it than not have it. So for me, it doesn't stop me growing pension wealth. It's just something to bear in mind and look at and manage. And those excess tax charges are 25% if you want to draw down the excess as income, and then you pay your marginal rate of tax, or you can just pay a flat rate of 55%. But again, I can come on to questions around that later if needed. So what types of pension product options do we have? On the far left, you'll see something called a stakeholder, and that was brought in as a government low-cost approved pension plan, wholly appropriate for many starting in pensions. It's often issued by an insurance provider, and it will have a sensible range of investment funds that you can access, from low risk things like cash all the way to equity funds offered by that insurance provider. On the completely opposite end of the spectrum, we then have SIPPs, which stands for self-invested personal pension, and Ssas, which stands for Small Self-Administered Scheme. And SIPP and Ssas are fully trust-based pension schemes, and they can potentially allow all of these different options. So that might be accessing investment funds from any provider or any investment that we can access in the investment universe. Buying individual shares, we could buy alternative assets like structured products, open different bank accounts, buy commercial property, maybe look at unconnected loans, or for Ssas, connected loans. Maybe even borrow funds, so you can borrow money in these pension schemes. These pension schemes can, full SIPPs and Ssas can borrow up to 50% of their net asset value. So if you had a pension fund worth, for example, £500,000, and it was in a SIPP or a Ssas, you could actually borrow an additional 250. So you'd have up to 750 of cash flow or liquidity. And in terms of your retirement options, you can look at the annuity option or the more modern drawdown option, where you can draw monies from the fund itself. In between, there are a few hybrids, and sort of they're sort of maybe a move towards that full flexibility. Maybe they don't have all the bells and whistles, but they're somewhere in between. And we might have their sort of what I call like broker SIPPs online, where it's more about getting access to the investment world in a sort of DIY or sort of cheaper platform. And personal pensions, similar, they might just give you more flexibility, but usually those in the middle ground don't give you all of the bells and whistles, just because for everything on the full self-investment end, it requires a lot more tailored and bespoke approach. It's usually much more bespoke and paperwork driven, creating genuine solutions to client problems rather than trying to keep a simple mass market product. So in terms of, often clients will say to me, well, if I did want a full self-invested pension, to look at some of those property options or loan back options, etc., what's the difference between a Ssas and a SIPP? And why should I, what helps me choose one between the other? When we go through this advice process with a client, we'd look at obviously what they need. But generally speaking, a Ssas has to be opened with a link to a trading company. So in order to have a Ssas, you need to have a trading business. And that's because under deed, Ssas are company pension schemes, or what we refer to in the industry as occupational pension schemes. So you need to have that company that establishes a company pension scheme for its staff and key staff and directors, and that's where having that link comes in. Because there is that link, so because by the trust deed you've got XYZ Limited established a Ssas known as ABC Ssas, whatever, just made that up. Because there is a direct link in the deed, it means that we can look at this loan back option where money can be loaned back to the business. That's why SIPPs can't do a loan back, because there is no linkage with the company by deed. So for us, typically, if a client might want to look at the loan back option, a Ssas is usually the sort of more pertinent. Both Ssas and SIPP allow investment in commercial property. They can both borrow money. So from that point of view, they're both the same. There are a few other things. So with a Ssas, because it is a company scheme and it is set up by the company, you can have the charges of the Ssas paid for by the company because it is a genuine company expense. In a SIPP, because it's a personal pension, it's set up for the individual, not through the company. You can't, because they might be treated as a benefit in kind. Well, they can pay for it, it's just it might have to be charged as a benefit in kind. So that's sort of some of the core differences between the two structures. So I'll run through a few case studies on the self-investment pension planning option, looking at property. So the first case study I've put up is quite a simple one, and it's something we commonly get involved with. We've got clients, they may have, in this example, they've got a limited company structure, but it doesn't matter, they could be self-employed or partnership. Important looking at making pension contributions, so we've gone through that discussion with them. They want to start creating tax-efficient wealth to grow it as efficiently as they can. They've got some scattered pensions. They've got pensions that they've accumulated from various employments, and they're sort of just somewhere in the background. They've not really reviewed them for a long time. They're drifting away. Might be performing well, might not be. And as a business, they're paying rent. So they rent a premises. I know at the moment, in the current climate, that things might change in some industries, but in the purpose of this example, they are renting their own premises. So that is a cost to their business. Every year they look at their P&L and they're seeing rent come out as a cost, and that's affecting profitability naturally. So we've had a conversation with them and we want to try and turn that cost into a saving. And so we sort of came up with a solution, which was to consolidate their pension plans, which they had about 80,000 each. Because, as I said, SIPPs and Ssas can borrow pensions, they can borrow funds to gear up a purchase. And ultimately, they're looking to buy their own commercial property from which their business can then trade. And that will allow their business to then continue paying rent. So that existing cost is already in play. It's already factored into their P&L, but it's no longer going to be paid to somebody else. It's going to be paid to their own pension scheme. So it now becomes technically a saving in a roundabout way. So let's see how this sort of plays out. We've got two clients here. Both, as I said, had about £80,000 roughly from in this case, sorry, it was just a pure £80,000 pot. So the clients have got £80,000 of pension wealth. So we transfer that into a pension. The company also wanted to make contributions. So they've had a profitable year and they want to make contributions to reduce their company corporation tax. So they've also put £40,000 each, 40 for each director, into the pension scheme, using up their annual allowance. Now, between the pensions that they had of 80 and the contribution they put in of 80, they've got a total of 160. So they can borrow up to 50% of their value. So they've borrowed another 80. So in total cash terms, the SIPP, Ssas, whichever we agreed to use, has got £240,000. That was used to buy a building, and the company now pays rent back to their own pension scheme. Now, I suppose if we quickly look at what the advantages are here, the building's owned in the pension scheme. I can't remember if I've got it here. So the building's owned in the pension scheme. So that's off balance sheet. It's off your personal balance sheet, which is a good thing. It's going to grow free of tax. So the rent that comes in, there's no tax on that rent. If we sold the building in many years to come, no CGT under current rules. Because the rent's coming in gross as well, so there's no deductions from tax, it also means we can pay the debt off quicker compared to having that debt in a post-tax environment. Because ordinarily, if you have a buy-to-let or property in a business, you'd have to pay some form of tax and then pay your mortgage off. And there might be some allowances here and there, but usually this does help with that. So this was a nice, simple sort of scenario. And again, that client now knows exactly what their pension is doing, and it works totally in line with what the business is doing, because the business was paying that rent anyway. In time, we'd naturally continue to look at funding contributions to reduce profits, and also sensible tax planning and other wider investments to diversify them over time. So this was a slightly different case study, again, that we've commonly come across. And it might be where you've actually got an existing commercial property on balance sheet. So in this case study, we've got a trading company with two directors. Doesn't matter, by the way, how many directors there are. You can have quite a number of multiple members in a pension scheme. You can have up to 12 in a Ssas. And technically, I think it's unlimited in a sort of family SIPP, but you don't want too many. But in this example, we've got two directors. They've got an existing commercial property on the balance sheet, 300,000. Now, it's quite common, and we see this, and we sometimes will discuss it with clients, that because pensions can only borrow up to 50% of the value, although it's generous, if you're starting out in business and you want to buy your own building, you sometimes want to maximize that loan to value. So it's quite common that clients will buy property like this on balance sheet in the company, because they can secure the debt over wider company assets and maybe maximize their mortgage position. But then over time, we sort of revisit that planning and say, well, actually, is that still the best way to own that building? Because let's have a look at the pros and cons. If it stays on balance sheet, okay, there's some great stuff that it's propping up your asset base in the business, but equally that's a risk. If the business ever gets a serious claim or any big liabilities, then the building could be taken away. Equally, if you're looking to sell your business, a few clients have been advised it's not always good to have property on balance sheet because you don't always get full value for it if it's part of the business. And in some ways, it can artificially inflate your sort of profit position if you're not paying rent. So they're just, again, there's not a right or a wrong, it's just different considerations. So in this case, we had a client with a property on the balance sheet. They wanted to ideally move it to the pension fund for all the reasons I said before around tax efficiency, but they haven't got the money just to throw 300 grand into the pension scheme without jeopardising cash flow. It'd be a nice position to be in, but it's something they want to watch. So the objectives were to remove the property from balance sheet and become more tax efficient and build retirement wealth in the format that we sort of went through before. So what we sort of went through with this client was we actually considered getting a bridging loan temporarily. So they borrowed money against the building on balance sheet. That allowed them to make a pension contribution. So literally the bridging money came in and then it goes straight back out into the Ssas. Now we were able to do that in this case study because with these clients, they had their carry forward. So we were able to maximise quite a sizable pension contribution for them. And that meant that the company was also allowed to offset that amount of contribution against its corporation tax, which created a potential for a significant tax saving against the profits for that year. So the Ssas was established to house those monies. They can also borrow monies, as we went through before. So the Ssas also got borrowings. The Ssas then bought the company off. The Ssas bought the property off the company, and that gave the company the cash to then pay off the bridging loan. And then, like before, we then had a lease to the pension scheme. So the business now has pays rent to the pension fund. So what we achieved in that example was after the bridging loan, and I appreciate there's a bit of cost in there, but just keeping numbers very simple, because the property's now moved and been sold for 300,000, and the Ssas took 220 on, got an 80k mortgage, and then paid that off. Because the bridging loan was 220 and we sold for 300, it's had a little bit of cash injection. So it's used the net equity in the building to put some cash in. Because it was able to make a big contribution, it's created the opportunity for quite substantial corporation tax relief for that year. There's going to be some ongoing corporation tax relief because the annual rent that the company will pay to its own pension fund will again be tax deductible. And the clients now have a much clearer understanding of where their pension strategy is going, and it's ring-fenced from balance sheet. And again, in time, we can add to that. We can look at other planning, sort of contributions, wider investments, etc. So that was sort of, again, just another sort of a potential case study. Loan backs. So here we're talking about pension funds loaning money back to the sponsoring limited company. So as I said earlier, a Ssas has a link with a trading business, also known as a sponsoring employer. So it's the company that set up the scheme. Now in the scheme rules, we can look at a loan back providing 5 tests are met. And those 5 tests are that the loan value cannot exceed 50% of the scheme net asset value. So for example, if you have a pension scheme worth £400,000, the maximum loan back that could be delivered would be restricted to £200,000, 50% of the scheme's net asset value. And the net asset value means it's the net value of the scheme. So if you have property in there, it's the property minus any debt gives you the net asset value. The maximum term of a loan back is up to 5 years. Capital and interest must be repaid in equal instalments. There must be a commercial rate of interest to make sure it's a genuine arm's length transaction. An important part is that we need to have a first legal charge as security on that loan. Now, this often comes down to flexibility. Not all providers like these transactions because they do require a lot of administration. So again, it's down to how flexible a provider is, and you've got to know how to manage this and report it, and then also manage the ongoing repayments and then make sure this is being adhered to commercially. So it does create a lot of compliance and internal administration. Again, it's not suitable for everyone. Not everybody should do a loan back. You've got to have a purpose, and you've got to have, ultimately you've got to have a purpose for the money. But it's got to be right. It's got to be commercial for everybody. We wouldn't want to accept business, and no, people out there shouldn't accept business if it's not right for the client. So, for example, if you've got £50,000 in a pension, should you do a loan back? Absolutely not, in my view. Because the cost of running this and the liquidity risks if things go wrong can be quite severe. If you've got a client who's very well established and they're sophisticated, they understand what they're doing, they've got track record, and this is just a small part of their overall position, can they afford potential for risk and maybe having to restructure things or access liquidity? Yeah, okay, well, we can see there's a story in that it's right for that client. Again, more on that in the Q&A, I think. So loan backs aren't for everybody, but ultimately they can be done. They can be a fabulous tool to help align your pension scheme with some business aims. So what security can be used for the first legal charge? Technically, we can look at all things. So land buildings, we can look at share capital of businesses, but again, we need to do a lot of due diligence and make sure that's adequate. And sometimes we might then therefore insist that we have second charges if we feel that share capital's a bit more volatile. It could even be assets investments. So, there are a range of things that can be looked at. So let's look at a case study. And this helps answer another question. Can you invest your pension in residential property? The short answer is no. You can't directly hold residential property. And if you do, there are severe tax charges. However, you can make pension fund loans to sponsoring employers that are trading businesses. And I have a few clients whose trading business is property development, and that's their genuine trade. So it's not a business that manufactures widgets and then on the side wants to buy residential in the business. The loan wouldn't therefore be for the genuine purpose of the trade. But for companies that are genuine development businesses that go out and buy something, make it better and sell it, that's their trade. So in this case study, we've got a property development business, and they've had a profitable year. They've completed some very successful developments, and they want to ideally fund their pension contributions because naturally that gives them corporation tax relief and helps build towards saving wealth in a different structure away from the business to sort of diversify. But they're mindful, as we all are, of cash flow. Putting money in your pension means that it might not be accessible, and they want to use it ideally as well to grow the business, to go to the next level or go to the next development. Now, we've identified that they have got some old pensions. So again, these clients have built up pensions from old workplace pensions and provisions for many years, and we've spotted that there's a quite considerable sum already with what they've got from past accumulation in pensions. So the solution here is to look at amalgamating those pensions, look at a loan back, and then make sure that's obviously met in line with the rules.
Greg, we're down to our last few minutes.
Okay.
Do you want to answer a couple of the questions for the ladies?
Yeah.
So one of the questions is with the Ssas and the sponsoring company, can that be an LLP or does it have to be a limited?
Oh, we got my brain working this morning. I think my understanding is it has to be a limited. I will double check that and come back to you, but I'm we have looked at this in the past. I've not got any LLP clients. I think my understanding is it has to be limited.
Okay. I think that's what Siobhan was thinking. Okay. And then another question, which I know has been a topic in our WhatsApp group for Ssas, is transferring in a defined benefit scheme. So that's the sort of old-fashioned final salary scheme. There's extra steps for checking this. What are the steps the ladies need to consider to transfer in a defined benefit scheme?
Yeah, so as I say, it's something we used to be able to do, but due to increased regulations, insurance costs, etc., we've stepped out of that market a few years ago. However, in general terms, the process basically requires you to firstly get advice. So if you're transferring, my view is if you're transferring any amounts, you should get advice. But I think the government set a minimum, whereas if the transfer value is above £30,000, they insist you have to have advice on that transfer. And the providers will often sense check that. So really, it's finding somebody that can give you the appropriate advice. They would then usually request a transfer pack to see what the transfer position is. And they would go through an exercise of doing a lot of due diligence around is it suitable to transfer or not, looking at various different factors like income sustainability, cash flow modelling, if what the sort of quantum's likely to support versus what you're going to get, and trying to get to a point where they will hopefully be in a position to sort of give you that advice, and that advice might be to stay or to transfer. So it's really about finding an advisor that's going to give you the right advice, understanding what the scheme is and what it offers you, and what you can obviously what the other option is that it's offering you, and then sort of going through those options very carefully and doing it. From a process perspective, you need to have the transfer pack, and that can take a little while to obtain. Usually, the transfer value that they give you is usable for about 3 months. So, and that means that the actual, if you want to take the transfer, usually the provider will insist that transfer sort of acceptance form be submitted within the 3 months. If not, they might then have to reissue a new figure for you then to sort of confirm. That will need to be submitted with all the provider will set out a stringent list of things that they need. Even I've had some that in the past that we've seen where clients have had to submit birth certificates and all sorts. So you have to really carefully look at that pack as to what's on there. Again, your advisor would advise if it's appropriate or not, but that pack would set out the next steps. And with that, they'd insist on seeing a signed document from the financial advisor with their credentials on, just to show that who has given advice, because the provider should also be checking that that's a genuine registered person and somebody that's suitable to give the advice.
So when you said that you don't do that, you just meant that you don't give the advice anymore, but you would take on the pension and the Ssas facility, but you would need an independent advisor to sign it off. Is that what you mean?
Good question, Suzanne. And I'm just trying to tread carefully because it's a very grey area. And our internal view is what we don't want to be seen as doing is facilitating something. So naturally, we love to have the right clients for us and for that client to come with us. I think for me the most important thing is the right advice that's being given. Unfortunately, what we can't do is be seen to pass on somebody's details to somebody that can give that advice, because I suppose our concern is that the way that the regulators think as well at the moment is that are we facilitating somebody to go down that route, and sort of if they get that advice and it was the wrong advice, they might still then say, well, Matt Illywood's helped in that process. So for me, to answer your question, we can't sadly get involved in that process. It's really a decision for the client to make with an advisor. However, absolutely, if clients are in a position where they have transferred and have got a pot of money, or have just got other pension money as well, or other assets, and they want some advice on that from that point, we were very happy to look at that as a client and help move things forward from there.
Okay, so if anyone in that situation wants to drop a message in the group afterwards, or Greg, can you put your contact details on the screen?
Yeah. Now I've put our company one. Sorry, I'll go to the end, but I'll share mine in the group as well with you. So we've got obviously a raft of quality people in our business. So my own details, you can find me on LinkedIn. I'm on the website as well, both our Manchester and Preston team sites. And ultimately my email address is the very same as the one at info, but it's greg.ward@matthewotherwoods.com. And I'll share my details. I'm more than happy to do that if you want to share my phone and my email.
Yeah, I'll pop those in, or you can come to me. So what we'll do is maybe send me your slides afterwards as well, and we can share the bits that sadly we missed because we've run out of time now. But thank you so much, Greg, for coming on a Saturday morning.
That's okay.
And sharing your knowledge with us. I'm sure lots of people have got individual situations, so Greg's more than happy to sort of have chats with people that are looking for providers, and no pressure, but